And I gotta get someone else let them in. Okay, so tonight we're going to be doing financial projections and cash flow. We are lucky to have Alain Paquette from Link North going to be doing the presentation for us, and I'll be just hanging out in the background, helping out with questions in the chats. Before we start, I'm going to do my land acknowledgement. So the Business Enterprise Center would like to acknowledge that we're located in the traditional lands of the Matagami First Nation, Flying Post First Nation, the Matachewan First Nation, home to many Ojibwe, Cree, Oji-Cree, Algonquin, and Métis people who have acknowledged that we're situated in Treaty 9, also known as the James Bay Treaty, which is steeped in a rich Indigenous history of many First Nations people, many First Nations, Métis, and Inuit people. Okay, so now I'm going to stop sharing my screen and I'm going to give control over to Alain. Well, he already has it, I think. Yeah, go ahead, Al.
Right on. Thanks for the introduction and pleasure to be here. Can everybody hear me okay? Yeah, we're good. Got some thumbs up there. Right on. So let me share my screen here. I don't know if I'll be able to see everybody in the background, but James will keep me posted on any questions and stuff that you guys might have. So again, like James mentioned, my name's Al Paquette. I work with Link North. I'm the business advisor. So I take care of giving grants and stuff like that to small businesses as well. My background is commercial banking and small business banking. So when James and Mike approached me last year to do this financial projection, it was kind of a different. Uh, you get a different eyes on things, right? When you're creating your business plan and getting your businesses started up. So obviously, with my experience in banking, I've seen a lot of business plans. I've seen a lot of financial statements. I've seen a lot of good ones, a lot of bad ones. So when I looked at this presentation, it kind of tied in perfectly with the background. So I'll definitely be able to give you guys an idea, especially from a banking side of thing and investment side of things, what they're looking for to make sure that you guys are successful, with your business, and then potential funding and growth and et cetera, et cetera. So I'm excited to do this for the BEC here. So we'll get started. So with the agenda today. Again, the introduction, that was kind of a quick introduction from myself, but we'll go through the importance of financial projections, financial assumptions. We'll go through the components of a financial projection, basically document or spreadsheet. We'll have a quick 5-10 minute break. And then we'll actually go through the BEC's, the Business Enterprise Center's financial projection template. So I have the template up. So we'll actually do kind of a mock scenario and just show you how the template works and how kind of user-friendly it is. And obviously answer anybody's questions as we go through it. The Business Enterprise Statements Guide to Projecting Your Financial Statements. So again, that's part of the second kind of run through that we'll do. Oh, there's the introduction again. So here, that's me. So the business advisor, Link North, background commercial banking, did a lot of commercial insurance sales as well. So kind of understand, different angles of running a business. So again, we'll go through this, keep everything on time here. So again, for the financial template, the financial statement template, I believe you guys have all been forwarded this link, or you guys should have a copy of the template for your financial projections. There's obviously other available, but for Starter Company Plus, we recommend that you use the link above. And that'll make it a lot easier when we do our example later on, if you want to follow along. So the importance of financial projections. So financial projections are arguably the most important facet of entrepreneurship and business planning. So it ultimately determines the viability. So it's essential when seeking financing or funding. It effectively communicates your projections, it allows you to effectively communicate your projections, which is very crucial. It's justifiable or defendable, and it must be sound yet realistic. So this is huge here, especially the viability standpoint. I don't know if you guys know, there's some stats out there that say most businesses, tend to succeed or fail within the first couple of years. And that's exactly kind of what your financial projection covers, right? It covers your first 2 to 3 years. And it's very important to put the proper information. You might hear me say that numerous times throughout this presentation, but it's do your research when you're kind of completing your financial projections, and then we'll go through this again, but again, just warning everybody that I might repeat myself there. Do the research, put actual numbers there, because it's so important to make sure that the project that you're undertaking, the business that you're undertaking is done so accurately. So again, there will be some financial assumptions. So those are general statements that explain why certain values are projected. So ask yourself, what are your revenues based off of? What are your ongoing expenses? Do I have quotes, receipts, etc.? And why? So assumptions should justify your projections. So they can tie in with the market analysis and the industry research that you've done. So again, you can think of trends, demographics, size of market, etc. So section 3 of this is the market analysis. So again, it's part of the guide to writing your business plan. So again, those kind of 3 critical questions there, and that goes back to that research piece. Do you have quotes, receipts, something concrete that you can justify that when you present this business plan and financial projection, did you actually do your research, or you just, where do these numbers come from, right? So it shows those investors, funders, bankers that you've actually done your research, and it'll prove that viability of your business moving forward. It doesn't take much time, but we'll go through a lot of these expenses kind of more in detail as we go along here. So the components of financial projections. So the startup budget and financing needs. So that's basically your startup costs and your expenses that you're going to incur at startup. So the source and application of funds. So that obviously will include any owner's equity, so any money that you're putting in, any financing, so any kind of banking or other financing available, and funding. So any kind of grant funding that you might be getting through potentially BEC, Link North, NOHFC, any kind of other funding agencies out there. So this is kind of where you would put that. So your financial projections obviously include your revenues, so your money coming in, your expenses, money going out. It'll include a break-even analysis. So again, we're going to go into detail all these kind of components here. The loan amortization schedule. So basically your loan, and then basically you put your interest rate and how long you spread it over. It'll give you, your as you pay it down, what's going to principal, what's going to interest. So you can put that in your projections. Depreciation schedules for your capital expenditures. So any kind of large assets that you have a life expectancy. So they depreciate, by X amount every year. So this financial projection spreadsheet will cover that. It'll help you with your income tax calculations as well as your projected financial statements. So again, that's the document that the banks or the financiers will usually look for. So for your startup budget and your financing needs, so AKA the source and application of funds. So essentially highlights 2 key aspects. So what you want to spend your money on, so those are your startup costs, and where the money will come from. So it could be your owner's contribution, so money that you're putting in, families, friends, loan. So again, debt instruments, so anything from the bank or any kind of financing, third-party financing that you might be doing to get this up and running, or funding, so grant funding. So again, it's important to be accurate. Use real costs, do your research. So again, kind of reiterating that point, make sure you do your research and put actual numbers, because a lot of people just project numbers and then they don't realize, what they're getting into until, they're ready to start up, and then they find out that it's way more expensive. So it's just a lot of headaches that could have been avoided with that little bit of research at first. So the total application of funds should equal the total source. So this component is also used to highlight required financing or funding for business startups or expansions. So again, just make sure you're using accurate numbers, and at the end of the day, the money that's going out should equal to the money that's kind of coming in. So here's a template that's part of the, or from that original link on the introduction page there. So this is kind of what it looks like. Again, we'll do a kind of a walkthrough through this at the second part of the presentation, but you can see there from, the cost of items. So basically you would run down this here and you would put in your, what the costs are there, and then your owner's contribution. So kind of saying like where that contribution is coming from, and then the loans and the grants, they got columns for each. So it basically at the bottom here should all kind of balance out. because obviously you need the right amount of startup costs to cover your costs. So for revenue projections, so sales equals your sales price, sorry, plus your number of units sold. So revenues are based on the following. So again, what will you be selling, products or services versus what you will charge. So other considerations when you're kind of projecting your revenues is your target market and your market share, daily, weekly, monthly sales patterns, novelty, customer base growth, and seasonality. Again, try to project revenues with evidence. So again, do your research. It's always best to be conservative with revenue projections. That is very important there as well. Again, everybody thinks they're going to make an exuberant amount of money with their great business ideas, so they put an amount that might not be realistic. And again, once they open up, or when they think maybe at the startup, they don't balance it. Obviously, at the beginning of a business, there's always that kind of higher revenue that kind of comes in, but then, depending on the seasonality, kind of could go up and down, right? So all these factors there, seasonality, daily, weekly, monthly sales patterns and stuff like that, are very important to keep into consideration when you're putting in some revenue projections. So again, here's the revenue projection worksheet here. So again, depending on the type of business that you run, you could have multiple products or services that you have there. Well, here it allows you to break it down. So everything that's in white in these spreadsheets here are items that you can actually alter or you can edit. And then the blue ones here, they're all locked in with formulas. So that's why, and everything kind of reads from the previous page as well. All the numbers kind of carry over from spreadsheet to spreadsheet as well, which you'll see when we do the example later on. So again, very important, just put your different kind of services, break it down so you can kind of know what your different money makers are as well, right? Because sometimes, one part of the business might bring in more than the other. So again, just specify the business or the revenues there from each part of your business. Expenses projections. So again, this consists of startup and ongoing costs. So it's the cost of goods sold. So obviously purchasing your inventory or any kind of raw materials for any kind of construction or whatever else you might be doing. It includes the owner's draws. So if you're, pulling out money, capital expenditures, backtrack. Capital expenditures, employment related costs. So any kind of salaries and wages, and general expenses, which covers a lot of different kind of expenses. So that could be your insurance and any kind of other startup costs. So again, if you refer to page 12 to 14 from the guide to projecting your financial statements, you'll see some examples there as well. So again, here it kind of gives you a few of the capital expenses that you could have. Equipment, furniture, website, leaseholds, and then a lot of your general expenses here, they kind of break it down as well. So you can see rent, business license and permits, insurance, legal fees, accounting, bank charges, et cetera, et cetera. You guys can read that there. But it also kind of calculates your employment related costs. So, your WSIB, your employment insurance, CPP, vacation. So again, really cool tool that'll kind of allow you to really have an accurate picture for your financial projections. And it's also a good reminder that, sometimes you might not think of your, trainings or your office supplies or your bank charges even, right? If you ever go to a bank, you need a business bank account, it's going to cost you, 20 to 50 bucks a month. So you know what? Budget for that, right? That's an expense that you're going to incur as a business owner. And even insurance, again, from my background in insurance, it's again, just important to do an accurate quote on that. Depending on the type of business you are, insurance could be very expensive. And it could make or break a business. Unfortunately, just kind of real life scenario, just because I saw this earlier today, a gentleman on a local buy-sell site was selling 2 limos, and he had plans of starting a limo business. But as soon as he got the quotes for the limo business, he realized it was astronomical, right? So unfortunately, it just wasn't something that he wanted to pursue. So again, maybe somebody that didn't do the proper research before kind of purchasing an asset. So again, just the importance of, putting accurate information there, doing the research so that, this is accurate information. Revenue and expense projections. So these 2 projections are extremely important because they will help they would help to determine the viability of your undertaking. So again, please do your research. So the grant committee, especially with this program, wants to see that you understand your target market and have projected your revenue and expenses accordingly. So other funders and or financial institutions will be even more severe in their evaluation of your projections. So if you're unsure on how to turn your market research into revenue and expense projections, please schedule a consultation with, I'm going to say James here, so they can go over it one-on-one. He's giving me the thumbs up in the background there. So, but yeah, it's definitely right. So again, do your research, research. If you remember anything, I hope that's the one word you do remember. Just put accurate information in there, because even this comment over here, where the other funders and financial institutions will be even more severe, they're not wrong. It's definitely true. So they're going to ask those questions, right? They're going to say, where did you get these numbers from? And if you can't give them a concrete answer, it's just going to give them, it's just going to bring up a red flag, and it's not going to be, it's going to put you behind the eight ball kind of right away, right? So just make sure that you have all that information ready. It shows that you're ready. It shows the investors that you're ready. So yeah, please do so. I see Caroline, Caroline, you have your hand up?
Yeah, Caroline.
Yep.
I'm just wondering, like, how do you get prices? How do you do the market research if your competitors are small town shop owners kind of thing? So like, if they don't want to disclose that information, it isn't public information, how do you get that research done?
Yeah, that's a good question. Depending on, again, it depends on that market and the industry that you're in, right? So it's tough for me to say, kind of what exactly. Every business is so unique, and they all have kind of different needs. If your particular competition, doesn't have any tangible stats, which is, I guess, potentially possible, it's probably just, we'd probably have to have a little bit of a discussion and just talk about it, right? Kind of figure out who your competitors are, and then see how you fit in, right?
Perfect. Thank you.
It's a little bit
Hi,
more
Alan.
unique, yeah.
I'll jump in here, and this is one thing
Yep.
that it might make you a little bit uncomfortable, but call them up, ask them how much it is, ask for a quote. Don't tell them that
Yeah,
you're
she's talking about her competitors, right? So I think she's probably looking at more of a revenue projection to say, like, her competitor is pulling in, X amount of dollars a month. Well, sometimes when you're not, big business, that information isn't readily available. Is that where I'm understanding,
Yeah,
Caroline?
basically.
But
Yeah.
like James
And
says too, right? You can contact your competitor, right? Because that's James brings up a good point there, and I think we had this conversation, or maybe I saw something recently. But your competition could also be one of your greatest allies as well. You can reach out to each other and learn from each other as well. So reaching out to somebody and say, hey, listen, I can appreciate your business, and it's actually kind of a, but I guess some people might think of it of, oh, somebody's, coming to cut my grass or something like that. So they might not be as open, but it's all about the way you approach things, right? Saying, hey, I'm just looking to start up a small business kind of thing. This is very similar to yours. You mind me asking kind of what's worked good for you, what worked bad, try to get some feedback from them. I've heard a lot of good success stories about people like that. But again, it all depends on the people, I guess, right? I've been lucky enough to hear some good stories. Not too many people, close the door on your face kind of thing, right? But they should be open to have a civil conversation. At the end of the day, all business owners seem to be, or should be, kind of open to professional conversations like that. So, because it could improve their business as well.
Awesome. Thank you.
And one more thing I put in here, I put the link for the financial performance data from actually they used to be called Industry Canada. I forget their exact name now. But in there, if the competition doesn't exist or not, it can give you an idea of what the average business is making in your industry, or what it is based on different sectors. And that's what I use when I make the sample business plans. I take the data from that website right there.
Awesome. Thank you so much.
Go ahead.
No problem. Thanks, James. There you go. Good questions. Love having, people ask questions. It means that you guys are listening. So I appreciate it. So feel free to put your hand up like Caroline did there. Thank you. So another key component of the financial projections is obviously your break-even analysis. So your break-even occurs when the cost of business equals its revenues. So again, break even. So it can be measured in units or revenue. So break even equals your total fixed costs. So your revenue, per unit, or your minus your variable costs. Again, could be a per unit basis. So the template does this for you. So again, it'll provide you with one break-even analysis based on all of the inputs that you put in. And then it'll also provide one scenario-based break-even analysis where you can actually alter certain factors so you can see what happens. So if you want to change, a percentage here or a percentage there kind of thing, depending on a loan amortization or something like that, then you can kind of tinker around with that as well. But again, the financial projection template that's provided does that all for you. So it's a really great tool. So we'll go over that again once we do the run through in the second part. So again, here's the break-even analysis. So again, you can see that there's no inputting here. It's all stuff that's carried over from the previous sheets that we've completed. So again, it'll just kind of give you different charts and it'll bring over all that information here. And this is the break-even scenario builder. So you can see the white columns here. So you can kind of change. So if you have an average price of, $1 or something like that, and you want to change it to say, hey, well, what if I change this product to $1.25? You can kind of change kind of your revenue stream a little bit there. So you can kind of calculate to where you want to be so you can hit that break-even point, or if you want to increase your margins. So again, the break-even analysis, so it's the combination of your revenue and your expenses projections. So again, it's very similar to the rate of profit. So it is where your rate of profit is high that you will make investments. So obviously when you're making money, that's when people will tend to invest in you. So if you cannot show a quick break-even, investors and funders will not be interested in your project. So quick does not have a definition because it will be based on several factors, such as, for example, the size of your project. So that's very true as well. So again, your break even, sometimes when you're starting up a business, it could take a month, it could take 6 months, it could take a year, it could take multiple years. Again, it's really dependent on the size of the project, the size of the business, and how the business works and how you've kind of set up your projections. So there's not a true definition there. But again, those two statements are pretty kind of straightforward in the middle there with regards to the, your profits are high, that'll make investments. So just like anybody else, right? Any businesses that making money, that's the type of business that people want to invest in. And if you can show a quick break even on your financial projections, then it's kind of making those investors saying, okay, well, I don't want to put my money into you if it's going to take me 3 years to get some return on it, right? Investors usually want to make money quicker than anything else, right? So again, I don't think I'm providing any earth-shattering news here. So pretty straightforward on the break-even analysis. So again, another item or another template that's on the projections template sheet, the loan amortization schedule. So again, this forecasts your principal and interest payments for the duration of a loan's term. So again, this is a critical item in projections since it demonstrates a business ability to meet potential loan repayments. So our template does this for you. So as long as the proper values are inputted, it's limited to 3 years, but we can assist you if you need to show a loan longer than 3 years. So there's a lot of tools out there that can project up to 5-10 years, depending on the type of loan that you have. But this particular template spreadsheet offers is limited to 3 years. So again, loan amortization. So let's say you're buying a car for 25 grand. Well, you put $25,000 as your loan amount. You're financing it at 5% interest rate over 5 years. It'll just provide you with that principal and interest payment so that you can include that into your financial projections expenses, right? And then this way, it'll also calculate the depreciation of those assets as well. So again, here at the top here, you can see the amount, interest rate, the term in months. It'll calculate the payment for you, so you don't even need to change that. And then your payment start period here. So you can actually change it if you wanted to start it in month 5. Let's say after 6 months or something like that, you're going to purchase something. So you can actually start that payment, halfway through that first year or even in the second year kind of thing. depending on, really what you're projecting and where your business is going and what your business is, right? So whether it's a car, it could be a building, it could be a piece of equipment or something like that, right? So it could be so many different things. But again, putting the amount here, it'll calculate your beginning balance, and then your payment. It'll calculate the breakdown, and then it'll give you the ending balance on the far right, so that you can know what your balance would be at the end of year one, at the end of year two, at the end of year three, etc. So again, a really good tool on calculating that. So the depreciation schedule. So that's basically any capital expenditures purchased depreciate in value over time. So again, I mentioned the car. So obviously we all know cars kind of depreciate as they go along. So again, I don't think I'm breaking any news there. So eventually, they will have no value and they will need to be replaced. So it consists generally of expenditures with value longer than a given period of time. So usually it's something that'll last over 1 year. So consider the following. So the effective life, the salvage value, and then the disposal fee to get rid of it. Our template does this for you with the proper inputs. So as long as you put the information at the right spot, it'll kind of calculate all of that for you as well. So again, that's another thing that some people don't realize is the disposal fee. I'm just kind of putting that out there, but sometimes to get rid of some equipment, it's actually costs quite a bit to get rid of things, and some people don't include that, which becomes a surprise when that time comes. So definitely something to think of when you're doing those depreciation calculations. So again, this is the depreciation schedule. So you can see, when you have your capital expenses here on the left-hand side of the document here, you can actually change that to say, car one or whatever you want to call it. And then you can put the effective life of it. So if you think it's going to last 5 years, and then it'll provide a salvage value as well. And then it'll automatically calculate the depreciation value, and then the closing value and the depreciation. So it'll let you know what it's worth at the end of year one, at the end of year two, at year three, etc. So again, it'll break it down based on your startup acquisitions, your year one, your year two, your year three acquisitions. So like I said, if you're looking to purchase something later on, you can put that in your projections, right? So again, just to make it as accurate as possible.
So we got a question here from Jim. Do we include appreciation or depreciation if the capital expenses are properties?
No. The expenses here, you'll always go, there's always a value there. So unless you're in a position where you're going to be taking the equity out and stuff like that, then it's going to rebalance your financial statements at the end. So when you purchase an asset at X amount of dollars on your finance, and then you register it under the business, so it's showing as an asset under your business, that value will remain the same there until you go and kind of pull the money out of it. And at that point, you're going to take the money out, but then you're going to have a new value on that asset because you'll have pulled that money against it, kind of thing. That's usually the only time that the appreciation is not something that is calculated on financial statements. Burnett, did I see your hand up?
Yeah, a question. What if you have assets that you own like before you started the business, but you're bringing them into the business, but you had them like a year or two before you actually started the business? How do you account for that in terms of the value of the asset and depreciation and all of that?
Yeah, that's what I would put in at the beginning when you're doing your startup costs. That would basically be an owner's equity piece kind of thing, right? Because the owner is putting in. So if you already have an existing, $1,000 computer, for example, and then you're bringing that into the business, so you would put that as a startup cost for $1,000. But then you would also
But my
put
question is,
that.
wouldn't it have depreciated for the prior 2 years? Do you put it in at the current depreciated value or the value
Correct.
at which you bought it?
You put it at the current market value, the current value of the item.
Okay. Thanks.
You're welcome. Yeah, so again, all the items here, again, there's not really much to be changed here other than the effective life of each kind of asset that you have there, but it'll calculate the depreciation costs there, or items there. So again, your income tax, again, another very important part of starting a business, and even from starting a business, is something that people don't think of very often. So it's important to, I really love that this template does that for you guys. So again, the estimate of income tax for a sole proprietorship or a general partnership. So again, the template does this for you. It's rough estimates only. So formulas used are not applicable to corporations. So again, depending on the type of business you're going to run, it's better for a sole proprietorship or a general partnership, and the formulas will be a little bit wonky if you decide to get a corporation. But again, just put in the information there and the template will do it for you. So again, this is kind of what it looks like here. So again, there's nothing really to input there. It'll all carry over the information from your previous kind of inputs that you did, and it'll calculate it all year. So again, there's not going to be any income taxes for the first year. So that's why there's only year 2 and year 3 based off of your first and your second year's income. But here it'll kind of give you the tax rates. James, I don't remember when the tax rates, you guys updated that recently, right? So everything should be pretty up to date. But again, nothing for anybody to calculate.
It should be, but even if it's off, it's just to give you guys an idea so that you know that you do have to pay those taxes. Like Alain mentioned, don't use this to actually don't use this data to file your taxes with the CRA. Speak to a bookkeeper, speak to an accountant to do that.
Yeah, exactly. It's just, again, to provide an accurate number, for your projections so that you can see how it's calculated. But like James said, nothing beats the professional help of a bookkeeper, accountant, when it comes to kind of managing your books, doing your income taxes and stuff like that. So they're definitely good people to reach out to when you're going through this. But this template is a really good tool. So again, projected financial statements. So this, financial projections template will create kind of like a mock financial statement for you. So your financial statement consists of a cash flow statement. So it'll report the inflow and the outflows of cash during a specific period of time. So it'll show your business's cash position, which is obviously very important when it comes to investors, banks, et cetera, et cetera. Income statement, so it measures a company's financial performance during or over a specific accounting period. And a balance sheet. So the balance sheet provides a snapshot of a business's financial during at any given point in time. So this is exactly kind of what a financial statement is for the most part. These are the documents that the banks are going to look for when you're going to go see them for a loan, or if you want to see a line of credit or any kind of money from them, basically. So it's really what we look at once we try to write a deal, right? So we need to make sure that the company is in a cash position. We need to know if they can service their debt, meaning do they make enough money to make the payments, just like anybody else would individually go to, buy a car or do a loan at the bank, right? What's the first thing they look for? They look for proof of income, right? And what do? They, do their calculations based on what you're looking to borrow, right? So it's the same thing from a business standpoint. So you can take a financial statement and basically that the financial statement of a business is basically the T4 or the notice of assessment of an individual kind of thing. It's what the banks look at, when they're doing their financing. So this is kind of what a cash flow statement looks like. So again, just kind of goes over the cash receipts that you have, and then, financing, because you could, if you brought in proceeds from borrowing, you borrowed 50 grand off the stock, off the hop, or you bought that car or whatever, or here in these cases, you got some grants and stuff that are kind of coming in. This is exactly kind of where you would put that money in. The income statement, again, this is kind of goes over, there's nothing to fill out here. This information is all pulled from the previous templates. But again, it just kind of shows you it'll show you your gross profit, your operating expenses, and then your operating profit, and then your interest expenses and other, your net income. It'll calculate all that stuff there as well. And then obviously calculate your income tax so that it can give you a net income number. So the net income number is basically one of the big numbers that financial institutions will look for, because basically your net income basically shows that you're making money. I see a hand up. Sorry, Justin, go ahead.
Yeah, it's just a question for the taxes on year 1. So, but obviously you don't have any profit, you don't have any, you didn't make anything. If you, let's say you paid $100,000 towards your business on, startup manufacturing and all that. When you claim that, how does it work? Because you obviously don't get anything back from the money that you've put in, but does it eventually come back when you do your taxes once the business is cash flow positive, or how does that work?
Well, I think for the most part, again, I'm not a tax expert here, so I don't want to gear you in the right way. So I will steer you to like a tax professional. But from my understanding, is that owner's equity goes in and is not, and I don't believe you get it back, but you obviously you could pull draws out of your business to eventually pay yourself back as the business, like you mentioned, is in a cash flow position where you
Okay.
can start kind of paying back, the owners for that equity kind of stake that they put in.
Gotcha.
But from a
Perfect.
tax perspective, I'm not 100% sure on that one.
And
Okay.
Justin, I think Christine will cover, basically, I think that's almost the same question I heard last time. So I think she'll cover that on Thursday.
Awesome.
And if
Thank
not,
you.
you can bring it up.
There you go. You got Christine Bedard. Is that who you have for the next session? Yeah.
Yep.
There you go. So you got a bookkeeper / account coming to make to do the next course on Thursday. So if you have any questions with regards to tax, she'll definitely be the lady to chat with there.
Sounds good.
But we were at cash flow, so the income statement. So again, the net income is the number that a lot of banks and financial institutions will use to calculate if you can repay it. And that's the one thing as well I want to reiterate, or not even reiterate, mention to everybody. I've seen it so much from a banking end where people come in and they might have $1 million in the bank, but on a financial statement they show net income of $0. Why do businesses do that? A lot of businesses try to expense everything through their business so that they don't have to, so they can save on taxes. But then when it comes to financing, when you're showing as $0 of net income, you can't support the debt of anything. Right? You got $0. You can't afford a $50,000 loan for that new car, or for the $20,000 line of credit that you need to make your payroll next month or something like that, right? Because it's the same thing like anything else, right? As if you're an individual, you go to a bank and you were to show a net income of $0, would any bank give you any money? They won't, right? But that's the same situation when it comes to businesses. They try to put everything through the business, and that's fine. That's within your right as a business owner to do that. But when you're looking for growth, especially in startup and stuff like that, if you want to grow in 2 to 3 or in 4 years or 5 years down the road, a lot of times you're going to need the bank's help. You're going to need investment help. And if you're showing that you're making no money, you can say, oh yeah, I put all my personal trips and all my personal gas and all my travel and entertainment and stuff like that through my business to save from paying the taxes, but it ends up biting them in the butt a little bit later on in life when they come to grow and when they need help. And that's an unfortunate kind of reality that I've seen personally being in the commercial, business space, that very successful businesses that you see out there in the community. And unfortunately, they just didn't manage not to say they didn't manage their books. They're successful. They got money. They got tons of money and stuff like that. It's great. But they're looking for us for help. And unfortunately, we weren't able to help them. So again, just to be mindful that don't try to put this as your kind of personal bank account and try to put everything under the business just to save for taxes. Because at the end of the day, you want to be able to show that. And even for personal, like if you're a sole proprietorship and your business income is zero and you're filing $0 for income taxes, well, you're not making any money either, right? Even though that you might have money in the bank and stuff like that because of whatever reason, just make sure that you're truthful and that you're aware that if you do claim everything and there's a net income, the net income is a big number. That's what we look at. Make sure that it's accurate, right? So, and then again, just plan and project. That's why those projections are huge, right? To understand kind of where the business is going. You want to make sure that you stay on top of that. And the balance sheet here, so again, it kind of goes over the cash that you have on hand, obviously the assets that you have, so equipment, all that stuff we kind of mentioned before. And again, it kind of auto-populates here, so there's nothing to input here. Any kind of liabilities, so any long-term debt, so any kind of financing that you might have, and then owner's equity, right? So this is kind of what we mentioned earlier. So the owner's equity. So if you had put in, $1,000 worth of equipment or something like that, you can include, that would be included here. And then your retained earnings. So you got your owner's equity. So if you take your liabilities, and your owner's equity, and that should equal to your total assets, something like that. Boom. That was the first part. Got any questions on the first part here before we get into the projections template kind of run through? No questions. I don't see any hands up. Everybody's still awake? Oh,
I had
hands
a
up.
question.
Sure.
Yes. So on that income statement where you were showing net income, is that income before the owner's draw is considered? That net income number there on that.
Yeah. Usually there's again, I think there's usually more lines here, but the net income usually is after the owner's draws that they do. And the owners can pay themselves through different ways too, as well, right?
But I'm saying, if your owner's draw has been taken out, can't that bring your net income down to practically zero if you're essentially pulling out the excess or whatever profit there is in the business? Wouldn't that bring your income down to zero?
I think you might be right because what I was thinking about was the before taxes, but it's before taxes, and then the taxes come out, and then after the net income, it is your owner's draws. If you pay yourself via dividends and stuff
so the
like that,
owner's draw
that
is
would come out
after the income tax
after
calculation.
That's
Okay.
why I got a little bit confused, because it depends on how you pay yourself, right? Some people will pay themselves through, like you mentioned, draws or dividends, so that would come after the net income. Some people pay themselves through kind of your regular employment related expenses, so they'll pay themselves a salary on an annual
I don't
basis or
think
on a
sole
bi-weekly
proprietors
basis.
can do that. That'd be awesome, but I don't think we can do that.
Fair, exactly. Depending on the type of
CRA doesn't
business, right,
consider
that
us
you have, right?
employees.
Yeah. I believe Kylie, you had a question as well.
Yeah, just kind of going back to the last thing you were talking about, businesses not managing their books very well. When looking at purchasing an existing business, how much does the previous owner's bookkeeping and whatnot, like these types of projections, affect potential support from the bank? Just to give you a bit more, like, I'm looking at some numbers from like the last 3 years where this business has projected a loss. How much does
Has
that
projected
factor,
or has had an actual
or sorry,
loss?
has shown a loss, a
Okay.
loss on their income statements, on their tax
Yeah.
returns? How much does that affect a potential buyer's ability? I mean, when we run the numbers differently, it does show a projected sorry, I've lost the word here, but a profit.
Okay. Yeah.
But yeah, like, I mean, we know how the books have kind of been manipulated previously, but so how much does that affect?
It's a huge effect. And talking from personal experience, I looked at purchasing a business as well, and as much as I know that the business is making money, they were running everything through the business, so that I unfortunately, like, I don't know if many of you are, but I just couldn't come up with, X amount of dollars. So I needed financing, right? I needed financing. I needed investment to make this acquisition. And unfortunately, what I present to my financiers or my investors was their existing, financials, which, yes, show an income, but it doesn't validate what they were asking for. Right. So like if your business, and like you said, I know the person, I know the business, I know that they were running everything through the business, right? But I know I wouldn't run it that way. But my bank is not going to believe me, right? Like, because they're going to go by the historical values that they have, and that's why they're going to look at the last 2-3 years of financial statements that they've provided. So, and they're going to see that while the business isn't making any money, they're not going to be able to debt service their loan at the end of the day. When it comes to banks, quick kind of, again, I don't want to be to be a banking thing, but they basically look at, we call it the 3 C's of credit. So they'll look at the collateral. So they'll look at the piece of security that they're financing. So if you're, doing a mortgage or if you're doing a car or equipment financing and stuff like that, they're going to want security. So they're going to look at the security. What's the value of the security? They're going to look at the capacity. So again, this is kind of where the net income is. So the capacity is the ability to repay your debt payments. So they're going to take the net income, they're going to divide it by 12, and then they're going to take that monthly payment for the thing needs to be at 1.25 to 1 of the total debt that the total debt servicing that's the kind of the number that they look for.
Sorry, when you
And
say debt
then
servicing, you're talking about repayment of money that we would be borrowing?
correct.
Okay, sorry.
So if you have a $500 a month payment, that's you multiply that by 12, that's $6,000 a month. If your net income is 10,000 and you got to pay $6,000 in repayment, then your total your debt servicing ratio would be that basically at 10,000 divided by 6,000. So it'd be like 1.3 or something like that. I don't have a calculator near me, but that's basically the number you would need to be at.
So options in this
Mhm.
situation then would be personal financing or
Yeah,
money
it'd be
already
high
on
interest.
hand.
Yeah, it'd be owner's equity or personal investments or, grant opportunities. So there's always possibilities there, but it's very tough because at the end of the day, that's what banks want, right? They don't just lend money to anybody. Unfortunately, a big thing is their collateral piece, right? They want to be able to say, because again, it's happened before where people will do a mortgage and then have it for a month and then they'll drop the keys off at the bank and they'll be like, here you go, have a good day. They got their money and see you later. And then the bank's got to go through all the legwork of, selling this asset. So they got to make sure that, they're able to repay it so that or the security is there so that if that ever happens, that they can sell it and recoup the money that they gave out kind of thing.
Okay, and just one more quick question.
For sure.
I don't know where it sits, maybe I missed it, but existing inventory, where does that fall into this type of
The existing inventory that you're kind of starting up with or that you're
well,
putting in
like,
yourself?
if you're purchasing a business, right, you're
Mhm.
purchasing existing inventory from the seller. And so how
Yep.
does that number?
I believe the inventory was in one of the first slides.
It was on the startup cost sheet. I saw inventory in
Yeah,
cell
I think
6.
it was the startup costs, eh?
Yeah, I must have missed it somewhere.
Yeah, it's in your startup budget template. So your inventory at the start, you can put it right there at the top there, with anything
Okay,
else. Where
yeah.
it says raw
I see.
materials, but then equipment and stuff like that is all there. So like you said, so basically your projections would be, starting on whatever date, and at that time, like you said, you're purchasing whatever $50,000 in inventory. That's where you would put it there.
Perfect, thank you.
You're welcome. Any other questions, or are we good for a 5-minute break before we run through a quick scenario? So, James, what are we doing? 5 minutes, 10 minutes?
Yeah, let's do
You're
10 minutes.
man.
We'll be back at 7 o'clock.
7 o'clock, we'll run through the scenario. So we'll see everybody soon. You ready to rock, James? Everybody back?
No one's got their camera on, so I assume so. Let's do this.
Right on. So 7 o'clock to respect everybody's time. We said we'd start at 7:01. So let's get going here. So we'll go through a quick kind of not analysis, but a quick kind of scenario. You're here? You're back?
Yeah.
There you go. So everybody's business will be different, okay? So some of these numbers and some of these things, especially for this scenario, they will be assumptions. So please don't shoot me for not using actual like concrete examples here. But we're gonna plug some numbers in here, and then we'll just show you how the different kind of tabs at the bottom here, so you can see from the startup costs, and then go to projection year 1, 2, 3, and then your amortization schedules. So you'll see kind of how everything kind of ties in a little bit here. So for the example, going to use a retail store. We're going to be a sports memorabilia store, so we're called Sports North. So you can actually change the title, put your business name up here. So you can do that at the beginning there. But for my particular business, again, this is kind of all just information here. So whatever's in white here, we can change. So I'm going to say I'm going to put $50,000 in inventory. So you go down your startup costs first and kind of figure those out. So equipment, I'm not going to need much equipment in my sports card store. All I'm going to need is a bit of furniture and some fixtures, some kind of display cases and stuff like that. So again, 5,000, 15,000, whatever amount you put there. But again, just make sure you've done your research, figure out what those display cases are worth, figure out, whatever else that you might need for your particular business. I'm going to need a website kind of started, right? So I budgeted about $1,000. I contacted, X marketing company. They've provided me a quote. I have a tangible proof that it's going to cost me $1,000 to build this website. Leasehold improvements. Got to do a couple renovations. Got to put got to fix the bathroom up a little bit. Just to get up and running. This is kind of where you would put your leasehold improvements before any kind of costs, that you would need before startup. And these are the last, this says 1, 2, 3, 4, 5 here. So here is where you can kind of put your own items there as well. So you can type in whatever really, marketing. You want to start some Facebook ads or something like that. So you want to budget, $1,000 because it's your grand opening and stuff like that. So you want to put some money in there. You can also include that probably in your general expenses as well. Probably, yeah, marketing should not be in your capital expenditures. It would be in your general expenses here. See, catching myself as I go through this. But capital expenses, so again, if you're purchasing any kind of laptops or equipment, to record things or whatever, this is where you would put it. So if you put laptop or computer, cost you, $5,000 for a computer setup, for your business. So again, just continue going down your startup costs. So your premises rent. So again, I put $850 for a month. Again, this is kind of like just what it's going to cost you to get started. So you might have to put your first and your last down. So it might be, $1,700 that you have to put in. Your business license and permits, insurance fees. So, insurance, again, contact your insurance broker, do quotes online. Very easy to find some accurate information there. So just make sure you put the right fees there. So legal fees, well, I'm getting a lease signed, so I need to get my lawyer involved to make sure he vets it properly. So going to cost me $750 to get my lease done. Accounting for startup, not really any accounting fees there. Bank charges, my first, to set up the account is going to cost me $50. Advertising, so there you go. There's the marketing piece. One too many zeros, put in 1,000 there. But again, just kind of go through all of these kind of items there and then put what you think you're going to need for your startup costs. And then once you input all your startup costs, you'll see at the bottom here, your total is $86,250. So to get this started, again, like we mentioned in the first one, your total here should equal to your total over here. So you can see the red box at the bottom right there shows that I'm at 78% of my startup costs based on what I inputted here. So here for my $50,000 of inventory, well, I put in $35,000 of my own money, but I also got a $5,000 and a $10,000 grant on the right here. So your 50,000 balances with your 50,000 that you put there. Where did the money for your furniture and fixtures come from? Again, owner's contribution. I had a few bucks saved up that I was able to put some money into the business at startup. But let's say for the improvements, well, I needed a $10,000 loan. So I'll take that off. And then this way it'll just kind of show us when it gets to the amortization schedule after, we'll be able to calculate that as well. But at least here it gives you an idea as to where the money is going for your startup costs, and then also where your money is coming from, to cover those startup costs. So again, it's good to go through each item and kind of figure out, okay, where's my computer investment going to come from? Is it going to come from my owner's contribution, or is it going to come from a loan or a grant? So again, all these kind of things. Sure.
Just go because Ashley's got a question here, and this comes up just about every workshop. If you're not starting up the business, you're purchasing the business or you're expanding. Imagine that we say startup cost. This is start of the project cost. So where you're going to go basically, from, when you're submitting this, the grant application. Imagine that's the start of a project instead of the start of the business. So you'd go from there. So anything like new that you're putting into the business, it might even just be the, what you're going to spend the $5,000 grant on. And then one more really quickly here from SureNet. Rows can be added, but I wouldn't do it. If you know how you're really good at working spreadsheets, go ahead. If not, ask me to do it because don't want to mess up with all the formulas.
Yeah, another thing you can keep in mind too, like these capital expenses, like if you wanted to include like computer and website into one kind of thing, you can kind of put it there, and even you can put a note like 1,000 computer and $1,500 website or whatever, right? Just to kind of keep track and keep you accountable as to where those numbers are coming from, just to avoid, like James said, messing too much with the formulas. Because like we mentioned earlier, all these kind of spreadsheets kind of talk to each other. So try to avoid any changes in formulas there. Go ahead, James. You said you had something else?
Yeah, Jim had a question, but it looks like he stepped away from his computer, so we'll get back to that.
No, I'm here.
No. Oh, okay.
Go ahead, Jim.
Yeah, my question is, right upon startup, I'm going to be entering a lawsuit against another company. It has to do with renovations on one of the business properties. Do I count that money in the startup cost because it doesn't really have anything to do with the starting of the business? Do I just leave those costs out? Like, how do I approach that?
I think for the startup costs, I would keep it out, but I think I would include those potential expenses in your projection worksheet when you input it there. So you can have, because if we go to the next page, which is your projection worksheet, here is where you would kind of put all your cash outflows. So all your kind of capital expenses or your general expenses here. But actually, that being said, I would definitely, put it. Actually, you probably should put it in your legal fees, but no, I'm going to take that back. I'm going to put it in your month to month here. So this way you can time it out, right? So if you know your lawsuit's going to cost, or your lawyer is going to cost you X amount of money, you can kind of put it, on whatever month of your projection, whether it'll be in year 1, year 2, year 3. We all know how, lawyers and lawsuits work and stuff like that. So sometimes it could drag on for a while. So there might be times.
I don't know. This is a learning experience for me. So.
Yeah, no problem. It's I'm sorry you have to go through that. Whatever. I'm sure going through lawsuits is not anybody's cup of tea. But from a startup point, no, I would not put like a pending kind of litigation or lawsuit in there, but I would include any kind of legal fees. As you can see in the projection worksheet over here, I would definitely budget something, right? Based off of, what your solicitor says, if you got to put down a retainer or whatever. But let's say, in March, I'm just using January, he's going to charge you $500 because you got to, I don't know, a court date that day or something like that, whatever. Again, just try to put something there because we all know legal fees. And if you know that's an expense that you're going to incur, definitely budget for it because it's going to be important on your break even later on.
Yeah. Okay, perfect. Thank you.
Hopefully that makes sense. But yeah, so don't put it in the startup costs. Put it in your worksheet. Just make sure you budget it somewhere in your projection worksheets, year 1, 2, 3 kind of thing.
Excellent. Will do. Thank you.
Okay, you're welcome. So yeah, so again, if we're going back to the startup costs here and your kind of your owner's contribution. So again, I kind of just evened everything out here, but again, just keep in mind to just kind of fill that out. So then you can see at the bottom, all the formulas are there. You can see on the bottom right, I'm at 100%. So my, startup costs allocation is basically the equals to my startup costs. So that's where you want to be kind of thing. So again, if you take out a number there, it'll change that number there. So again, this formula, these formulas are pretty good, but basically you want kind of grays all around. So again, every business will be different, so just keep that in mind. But feel free to tinker around with the numbers, right, till you get to where you need to, where you get your money from. So from this is the projection worksheet for year 1. So again, I'm a sports memorabilia store, so I inputted some numbers here. If you haven't looked at sports cards lately, you'll understand why I have $10,000 a month. I might not even break even with that kind of money because sports cards are crazy expensive nowadays, but that's a whole other subject. Sports, so I'm going to say memorabilia. I can't even spell that, memorabilia. So I'm going to say, again, just feel free to put some numbers down there based on what you think is accurate, right? Based on those key factors that we talked about earlier, your market analysis, your market that you're in, any kind of trends, seasonalities and stuff like that. So if you noticed on my sports cards, well, I started at 10,000 a month, I went up to 15 to 20,000. Well, that's because, if I'm looking at October, November, or September, October, November, that's when hockey season starts. And that's one of our big sellers kind of thing, right? Our hockey card sales tend to go up. So you know what? I put that seasonality. I think I did another example once upon a time where I was a landscaper. So, at first I started doing, kind of just basic lawn care. And then the following year I started doing snow removal. And then the following year I started kind of adding additional services. So you can do that from a year to year, on a year to year basis. So memorabilia, again, just kind of fluctuates with, your seasonality of, hockey season. Hockey, we're Timmins, we're a big hockey market. Kids are hitting the rinks. We got a lot of hockey tournaments in town. So, it brings in a lot of people on slower months in the summer months and stuff like that. It kind of dips down a little bit. I should probably dip it down a little bit because who wants to talk about hockey in July? So, again, just those are things that you can play with in your projections here, right? But again, if you look at the presentation that we did, just think about those key market trends, seasonality is important and stuff like that. So again, you can itemize as many products or services that you have. You can itemize, you got 12 spots here. So you can feel free to do as you please there. Again, it brings in the cash inflows from your original kind of application or your original startup costs. So if there's any cash inflows, any other kind of cash inflows, so if you were to take out another loan or something like that, before hockey season starts, I need to crank up the inventory. So I need to buy $50,000 worth of inventory. So I took a loan out. So this is kind of where you would put that cash inflow in because you're going to take in $50,000 in cash from, the bank to purchase that inventory. So in this case, because I purchased $50,000 or I took a $50,000 loan, well, my inventory is going to go up $50,000, right? So there's an in and then there's the out. So that should always kind of balance as well. So my inventory is going to go up, $10,000 a month worth of inventory should keep me afloat for quite a while kind of thing. But then as things start wrapping up, I start getting prepared a little bit for hockey season. And you can just kind of play with the numbers, right? So that was a big order there. So then I'm going to, dip down a little bit. And in the sports world or in the sports hobby and stuff like that, there's new products that come out basically every month. So you basically are going to be making an order for inventory basically every month for different products to keep your clients happy, right? So again, every business is different, but these are kind of just to show you, how the numbers are going to correlate, at the end and how it's going to pull up your break-even analysis and stuff like that. So month to month, I'm not going to pull any money out. I know within the first year of my business, I'm just going to leave kind of whatever money I have in the business. So, I'm not going to put any numbers there. Employee wages, I got one employee that I will pay, as minimum wage, just to kind of run the shop, in the evenings. So, 2,500 bucks a month, based on minimum wage should be plenty. But let's say, 8 months in before the next hockey season, I want to hire another guy. So it's going to cost me an extra, $1,000 a month for that extra part timer. So again, just make sure that, you build a business case and you don't just put, the same amount of money all the time or whatnot. So again, this is just an example, but be a little bit more thorough, obviously, and do your research when it comes to, what the wages are, how much is $20 an hour nowadays? How many hours are you going to give that employee? Caroline, I see you had your hand up there.
So I just need clarification on something if you can. Owners draw an employee wage if you're, let's say, sole prop or general partnership, married couple, whatever it may be. How are they different, or what can be different in the sense that in the previous presentation it says if you can't afford to pay yourself, the business isn't profitable. So is that an owner's draw or is that an employee wage? Like obviously someone needs to run it. And yeah, just like
Yeah, if you're running your own business, different businesses have different ways of, kind of managing their money kind of thing, right? So some people will pay themselves through their employee wages. They'll be an actual employee of their business. But I believe, again, I'm not sure on tax implications and stuff like that with regards to sole proprietorships and stuff like that. So again, maybe a question for Christine on Thursday. But like you said, if you're a
Caroline.
sole proprietor, go ahead.
Yep.
Yeah, for this, so basically as a sole proprietor, any revenue you make, you have to count that as, your salary, basically your salary. You claim that to the government. So you wouldn't, it's not like your salary, like wages, it's all the revenue you make counts as what you claim for the government. But then you
Yeah.
also get to, subtract your expenses. And again,
So-
that's just general, like your bookkeeper is the one that can set it up so it's done properly. That's just generally how it's done. Generally with sole proprietorships, like it's not a salary, it's just an owner's draw.
Okay, so it would be an owner's draw, not an employee wage, regardless how I calculate how much I'm giving myself, whether it's just the profit or whatever. I basically even out the sheet with the owner's draw.
Yeah. So like let's say you want to give yourself a salary of $2,000 a month. You would put that in owner's draw, not in salary.
Okay, perfect. Thank you.
There you go. Thank you, James. But yeah, so in this case, I had an employee, so I'm paying him his wages. So then, like we mentioned earlier, you can see the WSIB, the EI, CPP does all those calculations for you. So you can see your actual total your total employment related expenses there. So again, just putting some numbers in there. So from a capital expenses, I'm not really looking to purchase anything extravagant because everything's pretty brand new from my startup costs. So the first year, I don't really foresee to spend anything. So I'm not going to add anything, but if you wanted to, if you think in 10 months you want to buy some new equipment or your store, you need some more display cases because things are ramping up, then this is kind of where you would put it. And then same thing with any expenses that are going out. So your premises rent, well, I said 1,700, that was first and last. So now I know that I'm going to be paying $850 a month. So I'm going to just put my $850 across the board here. So again, this is kind of where you put that information. Whoop, went too fast. There you go. And then your business license. Well, again, you don't really pay that on a monthly basis, but your insurance, so $1,500, that was actually my yearly quote. So I don't have to pay that on a monthly basis. So I won't have to put that in until year 2. Legal fees, don't expect anything to come up. My legal fees was just basically my lawyer to review the lease. Bank charges. So I know on a monthly basis, I'm going to have $50 in bank charges to do. So we can put that all in there, because all these kind of small amounts will add up at the end of the day. So marketing, well, I'm going to say I'm going to do some quarterly kind of promotion at $250 every 3 months. I think that'll be perfect. There you go. Office supplies training. So again, if you're planning any training for your staff or any kind of subscriptions and stuff like that, well, I need to be a member on eBay to sell my stuff online. Well, I got to pay $150 a month to be an eBay authorized seller. So I got to pay that fee. So that's where you would put it under your memberships. And again, marketing and any other general expenses that you think you might need to include there. Again, you can't change these ones because they're in dark blue, but you can change these ones here that because they might not have been part of your startup costs, but they might be something that you're going to spend moving forward or spend money on moving forward. So again, if there's anything that you would need to add there, depending on your business, this is the spot you can do it. So again, anything that's in white, you can update on this here. So I like the utilities one. That's where I was going. So utilities, so heat, my hydro. So $250 a month. Again, this information should be able to get a quote. So if you're leasing an existing building, or if you're, purchasing a new building, especially when you're purchasing, you should get a copy of all the, utility bills that come with it. So you should have a year's worth, I believe, is what they provide. So you should have a good idea to put accurate information there as well. And obviously, depending on your space and the way it's heated and stuff like that, you can kind of provide a pretty good ballpark figure. So according to this business, I am not doing so well. So you can see at the bottom here, well, actually, total loan repayments here, but I believe I need to go put the amortization. So because I took that loan out for $50,000 here, so that was my first loan, because I don't believe I had a loan at the startup, or I did have one $10,000 loan. So I'm going to go put my $10,000 loan in here first. And we'll say we got an 8% interest rate, and we'll just keep it at 3 years, just to keep it within the timeline, because our projections here only show 3 years. So we'll just keep it like that. Oh, this is total months. Oops. So 36 months. So there you go. So that's basically kind of what your amortization schedule looks like. So you can see at the beginning, 10,000, then at the bottom right, at the end is 0. So you can kind of see, it calculates your payment here. So you're $313.36. So that, I believe, should have carried over right over here to $313.36. So you see my loan 1 repayment here. So it kind of automatically populated here. So whenever, again, it's probably something I should have covered at the beginning, but whenever you add a loan into your startup costs, or even whenever you add a loan in the projection worksheet here, make sure to update your loans down here. So you can fit up to 2 loans. So I wouldn't do any more than that. So the second loan was for $50,000. We got a 5% interest rate. We'll keep it at the 36 months. And I believe I started it in month 8. So we will start it in month 8. So here you can see it starts at over there. And then by the end of year 3, I'll still have $10,000 on here, $10,317.14. But again, it calculates that payment so that when I go over to my projections worksheet, it is shown there as well. So you can see it starts on the same month that I took that money in. So I'm going to make these columns a little wider here, just so, can I do that? Yeah, maybe it won't let me. Numbers are too big here, I'm assuming.
You'd have to unlock the sheet to do it.
Yeah, I won't show anything there, but anyways, so
And
you can
that's what I
see by,
yeah, everyone, I can unlock the sheet if that happens, we can unlock the sheet to make it and set it up properly for you.
Yeah, I guess I'm just probably working with some bigger numbers here, so they're just kind of blacking out. So I'm probably getting into the 6 digits negative here. That's probably why, because you can see the 85,000 here. So yeah, so it's the 26, so that's why it's 109,000 that I'm losing here, or cumulative cash flow, negative cash flow. So again, this shows based on my projections that I will not be cash flowing anytime soon. So that, again, this is the cumulative cash flow. So every month you can see that I'm a little bit short on cat, well, a little bit short, 14,000, 15,000, 29,000, 6,000. In those kind of summer months, I'm losing a little bit less money. But again, this is kind of where you need to go and figure out. Again, this is making me realize that, okay, well, based on my projections, I am not going to be able to make any cash, or I'm not going to make any cash in my first year. So if I go to year number 2, so again, maybe things start speeding up a little bit more. And now maybe I'm averaging out, $25,000 a month to, oh, what happened there? 25,000. So again, just more sales, things are getting busier, reviewed my market analysis. I've grown over year over year. Things are getting busier. Hockey tournaments are starting to pay attention. Hockey and popularity is getting huge. My memorabilia side of the business is really ramping up, really starting to see an inflow from there. It's kind of matching my hockey card sales now. So, it's a pretty even split moving forward. So again, just working on some numbers, that you need to input there. But again, like I mentioned earlier as well, just put accurate numbers, base it on, what you expect to happen. This might be an over realistic, to multiply my sales tenfold on my memorabilia. Might be a little bit ambitious, but my eBay store is really picking up. Things are moving fast. So we're gonna go with that, just so we can see the number at the bottom be a little bit more of a positive situation. So again, only the ins there. So the outs, again, owners draws. I'm not going to pull anything out. Well, maybe I'll pay myself, like $2,500 a month, just to say that I'm making myself something. Then my employee wages, well, they're going to stay around the same this year. I'm putting in more hours, need more employees to help with shipping all this stuff. So it kind of calculates it all there. So equipment, not really looking at doing any kind of big renovations here. We did we updated some furniture last year. Don't really need computer. Again, you can just play with kind of some things, right? Well, I'm going to want to buy a computer here because, a year and a half in, my computer is going to die. It's even good to sometimes put those unexpected expenses in there, just again, to avoid any potential issues later on. So again, $850, I got a lease for 5 years. So my rent is not going to change on a monthly basis, $850. I'm sure a lot of people in Timmins wish they can get a rent for $850, but I got a good deal. So my first month of the year, I need to buy my renewal for my business license. So that'll be $250. My insurance went up because I had a break-in last year. So it went up to $2,000. Legal fees, accounting, your bank charges, again, $50 a month. Oh, I had an NSF that month or something like that. No, I didn't have no NSFs. You wouldn't be able to project that anyways, because you don't ever want to project that you're going to get an NSF. So office supplies, again, marketing, you want to ramp it up a little bit more or get a little bit more sales. So we want to ramp it up to $400 a month. Just punching in some information here and rambling a little bit. Marketing, advertising, promotion, subscriptions. Again, my eBay fees went up $50 over year. So we're going to update that. There you go. So, again, just by pumping in those numbers, and you can see the loan repayments have populated at the bottom here as well. So they're keeping that into play. So again, my net cash flow month over month is still in the negative. So this is still a negative cumulative cash flow. So I'm not doing a very good job right now, based on my projections, to provide a good picture that a memorabilia store is very, It's not going to happen based on this, because nobody's going to invest in this if you're losing $10,000 a month, right? Pretty straightforward. So in order to do that, obviously you got to increase your sales or reduce a little bit of your outputs. So again, year 3, again, this is the same thing again. I'm not going to repeat it too much because I think we'll be able to go over, the income tax part of it here. So here is, your income tax based on the first year, so it's 310,000 is negative. So probably not going to pay anything because you lost 310,000. So government's not going to come after you, but just so I can have a positive number there, I'm just going to put an exuberant amount of money here because that should affect the revenue. So I'm going to put 500,000. How does it not populate there? Revenues. Okay, cash outflow. Okay, I think that's fine. So the income tax, well, I didn't change the calculator here. But anyways, in that original scenario, we were losing money, so there was nothing kind of being made here. But in the second, or in the year 3, because I didn't really put any revenues here, so it's putting me in a specific bracket here. So it's actually showing that if you had a positive, it would show you the tax bracket 15%. So it would calculate your percentage of taxable income would be 20%. So your total income tax would be about, $5,700 based on that $28,000 you netted last year. So again, by pumping all the information and doing the calculations there, it'll kind of populate your income tax. So this way, that when it comes to the following year, you know that you're going to have to pay this back, right? So you need to include that as part of your expenses. Well, it'll be included as part of your income tax on your balance sheet anyways. So here again is the capital depreciation schedule. So your furniture and your fixtures and furniture. So, you figure it's going to last 2 years. So then you can kind of see depreciation per year. It's going to depreciate to 0 in 2 years. So, but if you think they're going to last you 10 years, well, then again, you can kind of see the depreciation per year. It's basically going to divide the amount by the amount of years, and it's going to depreciate by that much year over year. So it depreciates in year 1 by $1,500. So the value after year 1 will be $13,500, et cetera, as you go down. So the website, it might last you a couple of years kind of thing, because that's going to be something that's going to be probably a year, because you're probably going to want to do updates on an annual basis. Your leasehold improvements, those should be good for about 10 years. Your computer, 2 years maybe with technology these days. And same thing with as you go through your list, you just basically kind of put a expected life to those items that are on your list. So again, depending on what it is, it might be different, but you can see that your furnitures and fixtures. So in here, so we acquired 5,000 in that first year. We bought some new display cases, so those are going to depreciate, over 5 years. In year 2, that should carry over something as well. I don't know if the formula is working properly, James, because wouldn't the 5,000 depreciate 4,000? Wouldn't that carry over to year 2? Oh no, there's no acquisitions there. So that only outlines the acquisitions. My apologies. So again, anything that you acquired in year 2. So we acquired a new printer in year 2. And year 3, again, we didn't put any information there, but again, just put the year there and it'll kind of calculate everything there. And if you think that it has a value at the end of the life expectancy, so if you think your furniture is going to be worth $1,000, that's where you would put it there as well. Which means at the end of the 10 years, you'll be able to get $1,000 for it. So this here calculates your break-even analysis. So because I skewed that number at the top there, it's probably going to skew the break-even analysis, but just try to show you a kind of actual chart. So how come nothing is popping up here? So your annual fixed costs are there, but your variable costs are outside of the formula. So that's not ideal.
It's because you put for your sales, you put the amount of sales and not the number of sales. The top column is the number of sales. And then so let's say you're going to sell month one, you sell 100 cards, and then you'd put what you'd put with the average value of the card is. So that way it
Yeah, yeah.
calculates both your numbers
calculates-
as well
It
as
calculates
the
it per unit.
per unit as well. Yeah.
Yeah, okay. So units, the average price. So the average price here. So if we say, so my average hockey card will be worth $10. So I sold 100 units at $10. So again, my sports memorabilia. So at the top part, is your units, like James just mentioned. My apologies. And then you put your average cost. So again, your memorabilia, you're going to sell 20 pieces a month, and you're going to average it out at $100, $100 per item, for example. And then that'll kind of calculate your total revenues here. So your break-even analysis obviously shows that you need to make a lot more money in order to, your profits are at the bottom, the blue line. So my revenues are here, and then your total costs. So my costs are way too high right now. So I would have to play with those numbers in order to figure it out. But this is where where's the break-even analysis here? So on the left-hand side is the numbers that are carried over from the inputs that you put in. And then the break-even scenario builder here is where you can kind of play with those numbers. So if you want to keep the average price and then change the amount of units, this is kind of where you would put that information in to calculate where you need to be to get to that break-even point, or how many units you need to sell in order to get to that break-even point. So again, just putting different numbers in, kind of copying and pasting what's on the other side here to keep those expenses in line, because those numbers shouldn't change. You're just really looking to change the amount of units here to see kind of where your break-even point is. So you got fixed costs of 71,462, but you need to bring in that kind of money. So right now we're only bringing in 47,000, so we need to bring that up. So if we say $150, still didn't really do much. And then 90,000. This was working earlier. I don't know what I did. But again, this example might not be working to the best of my abilities here.
You
But
have
again,
to enter your units of increment.
your units of increment here,
Yeah.
based on
both sides. So yeah, so like if you're, let's see here, your total. So you look at your total units sold as, for some reason it's negative 686. That should be a positive. But what it'll do is, so you're selling, let's just say you're selling 1,000 units, you're going to break it down every 100 units, and then that's where it'll create the line for you.
It'll create the lines. So again, maybe a tool that I need to familiarize myself with. My apologies, but yeah, this is definitely, fun to play around with to see where you need to be in order to get to that break-even point. It's a good tool to have. And again, the information here, I might have just put a little bit too much information or didn't put the right information here. So just make sure you put units there, and then you kind of break down the average cost per unit. So again, whether, like I think I said, I was doing a landscaping business, so I did lawn sales. So every lawn was, $50. You did 10 lawns a month kind of thing. And then you can kind of break it down that way. And then this way it brings it up over here. Then again, you can kind of play with those numbers on this one, but you can't really play with them here. So again, it brings you to your cash flow statements towards the end as well. So again, year 1, year 2, year 3. So you can see the cash at the end of the year is not ideal. We're obviously losing money. So this is not a good scenario here. So we'd have to obviously play around with some numbers to make sure that this is a viable business, because based on this, it's definitely not a viable business. And your income statement, so again, pulls all the information from the information that you've inputted in your projections worksheet in the year 1, 2, and 3. Again, remember that we didn't put anything for year 3, but year 1, year 2 should be pretty accurate based on what was inputted there. So your income before, before taxes in the first year was 281,000 in the negative, then it was 84. So I guess it was a little bit of a better year, but I think that's in year two, you saw that I increased my sales on an annual basis to much bigger amounts. So whether that's realistic, probably not. But again, by putting accurate information, this will actually provide you with accurate information that you can use, as part of your business plan. And then the balance sheet, sorry. So again, shows you the cash position. So if you look at your cash flow statement, everything here, so your cash at the end of the year, 183, 312, carries over here. So then again, this here shows your total assets, which is a negative, and then your owner's equity, and then your total liabilities and equity as well. So your total liabilities minus your owner's equity equals your totals liabilities and equity, which is also the same amount as your total assets. So again, that's how they balance it out. So 287, 972, 287, 972. So everything kind of balances out. It's obviously in the negative, so not ideal. But again, if you put a proper, financial projections together, it'll all balance. It should balance out. You don't want to see negative. If you see this stuff, then you got to go back to the drawing board and kind of see kind of the mistakes you made or opportunities that you need to look into to improve your projections. So again, that was basically a quick run through. Again, just if you go through all of this here, especially at the beginning when you put up your startup costs and you do your projection worksheets, everything kind of feeds into everything else. I think I just got a little sidetracked by these numbers not kind of populating, so my apologies there. But yeah, otherwise that was it. Does anybody have any questions with regards to the worksheet that either myself or James might be able to answer?
And one thing, if you guys want, like, you try to use it yourself the first time and you're like, this isn't working, I don't know what's going on, don't be shy, give me a call, send me an email, and I can set up a session, we can share screens and we can go through it together, so you can ask your own specific questions. Like it's how, like Al did a great job there. It's just hard to do it for a made up scenario where you as you can see, you make it up and
just taking numbers on the fly kind of thing, right?
You don't get what you want. So that way, yeah, like we can, I can get together with you, one-on-one, and we can go through, each sheet, each cell, just if you want, do it, anything. I remember Shanette mentioned about adding lines, I can add the lines for you and then just lock it again so that all the formulas work. So yeah, don't be shy, don't be shy to ask for help.
Yeah, this is kind of like just a generic kind of overview of the spreadsheet and the worksheet. So yeah, feel free to reach out to James. James is the man. He's done this so many times with the starter company plus participants. So he definitely knows this worksheet front and back.
And it will be one thing that we will be doing is, if you want, I can also create an online sheet for you. So instead of using like the Excel sheet you save, I can put it in Google Sheets so that we can both have that, like we can see it online and we can work on it together live. That's something that, if you want to do that, we can make that work as well.
Cool. Otherwise, any other questions before we wrap this up? James, you want to take over, do your ending spiel?
Yeah. Okay. So my ending spiel is, thanks a lot, Al. I don't have the background in banking, so that's why it's good to know that, I couldn't explain it like you did, all the different sheets and what the bank wants to see, or funders. Don't forget, on Thursday, we're going to have Christine Bedard will be here to talk about the value of good bookkeeping. And then we'll get another 2 weeks off. We start up again on the next Tuesday with a session on marketing. Thursday after that, pitch, another 2 weeks off. And then whoever wants to apply for the grant has to show up for the pitch session and do their pitch on the 13th. Or maybe, don't worry, I'll send emails to anyone. And I just want to make sure, like, I do send emails out every morning before the workshop to let you know, remind you there's the workshop, there's the link. if you're not getting those, send me an email and I'll make, maybe you signed up with a different email address than you actually use. So I'll make sure you get that. And I think that's about it. So any questions, let me know now, or, send me an email, give me a call later. Or if you want, you could even stop by the office during working hours.
Have a good night, everybody.
All right. Well, thanks a lot, guys. Have a good
Thank
night.
you.
And I'll never say this again, but go Flyers, go.
Thank you, James. Thank you, Al.
Have a good
See you
night.
guys. You're welcome.